Good afternoon, everyone, and welcome to Biden's Tax Plan's Potential Change on the Horizon, Impact on Canadians, presented by Zeifmans US Tax Partner, Stanley Abraham. Before we begin today's webinar, I would like to quickly review a few general housekeeping points. Please feel free to ask questions throughout in the chat section, which is located on the lower left side of the screen. We will try to answer as many questions as we can during the question and answer portion at the end of the webinar. We will be recording today's webinar, and you will receive a copy of the recording shortly after the presentation is complete. With that, I'd like to introduce to you Stanley. Stanley is an expatriate New Yorker with more than 30 years of U.S. and international tax experience. He has a broad range of U.S. tax experience, advising clients ranging in size, from small owner-managed companies to large publicly traded companies. Prior to joining Zeifmans, Stanley was a partner with KPMG's U.S. tax practice in North York. He has been a certified public accountant in New York State since 1984 and is also designated as a chartered accountant in Ontario. Stanley holds a master's degree in U.S. taxation from Baruch College, the City University of New York. Stanley has spoken before the Council for International Tax Education, Atlas Structured Finance Institute, the Ontario Tax Conference, the Canadian Bankers Association, Federated Press, AJAG, and other trade and industry groups. A round of virtual applause and welcome, Stanley.
Thank you, Lauren. Today we're going to discuss Biden's tax plans. These are based on information provided in his platform and various analyses that's been circulated through the press. I'm sure over the last 6 months or so, most of you have gotten used to Zoom meetings where you get to see the presenter face-to-face. Today you'll only be looking at the slides. You will not be looking at the presenter face-to-face, which those of you who know me can vouch to those of you who don't know me that you're really not missing much by not seeing me face-to-face. So onward with the presentation. The items we're going to be discussing are the following: the potential changes to corporate taxes if a Biden agenda moves forward, potential changes to personal income taxes, potential changes to death taxes, and should Biden win the election and or carry Democratic Congress, what the legislative hurdles will be to passing any new legislation. The first item we're going to discuss are corporate tax changes. And the first change and the biggest change that is being proposed is raising the federal corporate income tax rate from 21% to 28%. Now, it was only a few years ago that the corporate income tax rate was 34%. So if you're looking at the proposed 28% rate and comparing it to the Ontario tax rate of about 26.5%, for those who do not get the small business deduction, you're saying, well, it's not such a big difference. What's the big deal? But that is just the federal tax rate. It does not include the state tax rate, and about 45 out of 50 states in the U.S. impose a state tax rate in addition to a federal tax rate. And almost all of those states, though not all of them, impose the tax on net income also. So for the purposes of this discussion, let's assume that the effective state tax rate is about 6% on average across the U.S. So we're really talking about a combined rate of 34% between federal and state. And if you pay 34% tax, you're left with 66% after tax, which at some point you might decide to dividend up from the U.S. corporation to the Canadian parent in most cases, and that dividend will also attract a 5% withholding tax. So you're moving from 34% to over 37%. Comparing the 37% and change to 26.5% in Ontario, you have a fairly big difference. That's more than 10 percentage points difference between the two rates. So what would we do? Even though currently at 21%, the numbers are much more neutral, we would have to consider transfer pricing maneuvers for our Canadian-based multinationals. And what that would typically do, consider the example of a company that has about $1 million of pre-tax income worldwide, and let's say 80% of their sales in the U.S. Well, the U.S. would be very happy to subject $800,000 of the $1 million to tax, but that $800,000 taxed in the U.S. will attract more than $80,000 of extra tax in the U.S. as opposed to that amount being taxed in Canada. So what we would do is we would sit down with the client, and even though we don't do transfer pricing, we give ideas for transfer pricing, and we would say, okay, do you have technical know-how in Canada? Do you even have patents in Canada? The ingenuity of management based in Canada is providing most of the impetus for the profit, the bottom line. Therefore, even though 80% of your sales are to the U.S., perhaps only 5% of your profit on U.S. sales should stay in the U.S. because most of the work is being done, most of the heavy lifting and work is being done in Canada. And in that way, we could, in an example which I just provided, we might be able to reduce the amount subject to tax in the U.S. from $800,000 down to about $40,000 or $50,000, which represents over a $75,000 tax savings to a company making $1 million. If you're only making $200,000, it's a $15,000 tax savings, but a tax savings is a tax savings. There's also going to be an alternative minimum tax on 15% on corporations with book profits of $100 million or more. We don't see very many of those here. A potential planning mechanism is that if Biden wins, and this is a real possibility of happening, we would tell clients to consider accelerating net income and decelerating deductions into an earlier year so that subsequent years would have less taxable income. It might be worth it in those circumstances. Individual tax changes are what are getting all the buzz in the U.S., and that's what everyone's talking about. The first change that is being proposed is that on wages greater than $400,000, there's going to be a bit of a surtax involved, and let me explain how that works. In the U.S. right now, the maximum tax rate is 37%, generally applied to incomes of over about $500,000 or $1 million, depending if you're married filing jointly. The U.S. equivalent of CPP is divided into two components. One is Social Security, which is 6.2% for each the employer and the employee, and the other part of it is 1.45% in Medicare tax, each for the employer and the employee. Now, the 6.2% Social Security tax is currently capped at about $137,000 of maximum earnings, much in the same way that CPP is capped, albeit at a much lower number. However, the 1.45% Medicare tax is not capped, and it applies to every dollar earned in wages. Now, Americans working in Canada should not be worried about this because we are exempt from Social Security tax under the Social Security Totalization Agreement between the two countries. However, what is being proposed is that in the U.S., for wages up to that cap of $137,000 or so, you're paying the 6.2%. Then there will be a hiatus for wages between $137,000 to $400,000. But once you pass $400,000, you will be subject to an additional Social Security tax of 6.2%. Now, if you're self-employed, that 6.2% is doubled to 12.4%, which becomes a very big number. As well, income over $400,000 will be subject to the maximum tax rate, proposed maximum tax rate of 39.6%, as opposed to a higher income threshold being subject to a maximum rate of 37%. And that rate is somewhat adjusted if you're a married couple filing jointly. There's a phase out of something called a Section 199A deduction, which really applies to individuals who are working for S corporations, which is a bit beyond our discussion. And there will be additional limitations placed on itemized deductions. Now, to illustrate how this tax will work, I've given an example of Jane Williams, a successful lawyer, is contemplating a partnership position in a Silicon Valley law firm. She earns well over 7 figures. What will her marginal tax rate be for each additional dollar that she earns? Well, we'll have the federal maximum rate of 39.6, plus, as the lawyer is likely self-employed because this lawyer is likely a partner in the firm, the lawyer will be subject to 1.45% Medicare tax, doubled because they have to pay the employer and employee end of it. There's a California maximum tax rate of 12.3% for now, which possibly may go up as a result of COVID. And now this new Social Security tax of 6.2% at each end, since she is self-employed, it goes up to 12.4%. And if you add those numbers up, you get 67.2% marginal tax rate on each additional dollar earned. Now, many of us in Canada are used to, if we're over a certain threshold, being in a position where the government says one for you, a little bit more than one for us. But here you're talking about a number where the government is saying one for you, a little bit over two for us, which is really quite onerous. And even if the person is employed but not self-employed, you're just taking off 7.65% from that number, and you're being taxed at around 59.5%, a number which is high enough to make any of these people hug Justin Trudeau the next time they see him. It's so high. What should we assume that professionals and others want to earn? Remote working is now viable, which means that there's a potential migration to low and no tax states, individual tax states like Florida and Nevada, to at least get rid of that 12% and change of state tax rates. In fact, I was just reading yesterday that David Tepper, who runs a big hedge fund out of New Jersey, has been slowly moving all of his operations down to Florida, and everybody's moving down to Florida, which is not good for the tax base in New Jersey or in New York, wherever any of these people lived. And a lot of people might try to work remotely. Now, there are also certain professionals, let's say you're a very successful surgeon living in California, you can't exactly migrate in many cases to a lower tax state. So what I anticipate happening is that a lot of people who are earning that kind of money might take an extra day off year-round to go golfing or something like that. Another change, which could be a potential problem for Canadians, and I'm just putting this in a separate category because it does impact Canadians more directly, is that for people who earn over $1 million, there's a proposed tax on capital gains and dividends, which are currently capped at 20% in the U.S. They want to raise that to 39.6% rate on all of this type of income, which was normally subject to a 20% cap. This could present a problem for high-income Canadians because in the past, the Canadian tax was always higher. Now you might be in a position where the U.S. tax on these items is higher than the Canadian tax, and you might have foreign tax credit mismatches whereby you owe tax in Canada as well as the U.S. Now, what Biden's proposals do not include is they do not include Elizabeth Warren, had proposed when she was running for the Democratic nomination to tax investors on a mark-to-market basis, which means that just on the appreciation of, let's say, your stock portfolio, regardless of whether or not you've sold the stock, of course, they weren't going to give a deduction for any losses that you had. You know, it's sort of a heads we win, tails you lose approach. But it does not include this proposal, which I suppose makes it more moderate than Elizabeth Warren's proposal. Problem number two is if you're a U.S. citizen living in Canada and you own a Canadian corporation, you've gotten hit with a lot of tax shocks over the last few years, but the one that, the gift that keeps on giving on the tax front is something called the GILTI, G-I-L-T-I, which stands for Global Intangible Low Tax or something like that. And it applies to U.S. person or persons who own greater than 50% of a non-U.S. corporation, because that corporation is considered a controlled foreign corporation or a CFC subject to the GILTI rules. And it applies a tax on the business income of the CFC, adjusted for certain items such as fixed asset investments where you can deduct 10% of that number, and interest expense, which has to be deducted from the 10%. Effectively, the effective rate currently, to simplify the tax, and it's a very complex tax, U.S. citizens in Canada who have a CFC are probably paying close to 1% on any income left inside the CFC, which is a nuisance, but a bearable nuisance. And that's if the U.S. citizens are being taxed at the small business tax rate of 12.2% in Ontario. Under the Biden proposals, that less than 1% number may go up to around 11.2%, as will be illustrated in the next calculation, in the next slide rather. And the calculation is as follows. I won't walk you through every line of the calculation because I don't want to lull the participants in this webinar into a semi-coma, but I would just draw your attention to the second line where it says effective GILTI rate under the current law is 10.5%. Under the Biden proposals is 21%. And that $10,500 difference on the line below flows right through down to the bottom, comparing $740 of tax to $11,240 of tax, or 0.74% to 11.24%. If any of you are U.S. tax groupies, you can feel free to work through this calculation at your leisure, but that's on you. Yeah. Now, how do we plan out of this GILTI? And this has been an ongoing question, but it becomes much more compelling when you're dealing with an 11% GILTI. Number one possible way is do not take the small business deduction and get taxed at 26.5%, the regular Ontario tax rate. There are a number of ways to do this. I won't speak to them because I'm not a Canadian expert. I'm a U.S. expert. And you might say, well, that's not fair. I don't get the 12.2%. What's the point? And the answer is that since the Canadian tax system is integrated, you're better off paying 26.5% versus taking the money out and paying 53.5%, and at least you'll be equivalently credited when you distribute the money later on. Whereas if you pay 11.2% U.S. tax, you're taxed at the individual level, not at the corporate level, and there are no foreign tax credits available for it. It goes into a separate basket, so it's just an out-of-pocket cost, which is non-integrated, which really doesn't work out well for U.S. citizens. Another potential way to avoid the GILTI tax is to transfer ownership of the business to a non-U.S. spouse. Now, that's easier said than done. If you have a non-U.S. spouse, there are annual limits of about $150,000 U.S. as to how much you can gift to a spouse. Even though that transfer might be tax-free on a Canadian basis, it could attract tax on a U.S. basis. So you might want to consult with a U.S. tax professional before you undertake the transfer ownership, just to make sure that you're not going to trigger any U.S. tax. There are some alternative structures dealing with unlimited liability companies, which you might want to consider. We will get into that in the next few slides. There is also the possibility that you might decide to renounce U.S. citizenship, which many more are doing than have done in the past. But if you are a high net worth individual, you might have some issues with becoming something called a covered expatriate, but that could be the subject of another discussion. Now, some people might think, well, what I'll do is I'll just invest in certain real estate deals or some other deals where we're generating losses, and by doing that, I'll be able to reduce the GILTI by running those losses into the Canadian corporation. And the answer to that is that that really doesn't work under the tax law because the IRS and U.S. Congress requires you to separate business income from investment income in doing this calculation, and the calculation is only done on the business income. You do not include any non-business income or non-business losses or investment losses, etc. So let's talk about unlimited liability companies. We have a U.S. citizen resident in Canada with the very Canadian name Gordon Canuck, who owns 100% of an unlimited liability company. Now, why an unlimited liability company? The unlimited liability company is treated as a corporation from a Canadian tax perspective and is therefore eligible for the small business deduction, which is definitely desirable for Gordon Canuck. However, for U.S. purposes, it's treated as a flow-through. If it's one owner, it's something called a disregarded entity, but a flow-through. If it's more than one owner, you have effectively a foreign partnership for U.S. purposes. Now, since it's a flow-through, it circumvents controlled foreign corporation treatment, and therefore it's not subject to the GILTI tax. Now, what is an unlimited liability company? Unlimited liability companies can only be organized at this moment in time in Alberta, BC, and Nova Scotia, but can operate in Ontario. I would tell you that I own an unlimited liability company organized in BC that operates solely in Ontario, so it can be done. Each jurisdiction presents challenges with respect to liability issues. I'm not a lawyer, so I can't give you the exact legal interpretation, but the way I would describe it is that each of them has very good liability protection, but not absolute liability protection, or a liability protection equivalent to a regular corporation, which we'll discuss in the next slide. And the other disadvantage of setting up like this, now sometimes you have professional corporations, which under the regulatory rules in their profession cannot set up as ULCs. They have to set up as PCs, or the equivalent of PCs, professional corporations. And even if you want to set up a management company to sort of run some profit through there to mitigate the GILTI, it could be problematic. About 2 weeks ago, I was dealing with a dentist that was thinking of setting up a management company, but it was pointed out that the paying a fee to the management company would attract 13% HST. There would not be an equivalent input tax credit available to the professional corporation to deduct the HST because dentists were an exempt service not subject to HST. So it doesn't always work perfectly for professional corporations. If you're a little wary about the liability protections, I propose the following structure, where you basically interpose a limited partnership between the ULC and Gordon Canuck and just set up a GP to own a nominal interest, because any partnership needs more than one partner. That might be a potential solution if you're looking for the type of liability protection only offered by limited partnerships or corporations. Under the alternative structure 2, which I just showed you, the unlimited liability company is a corporation eligible for a small business deduction in Canada. It is still a flow-through for U.S. tax purposes, and it will assist in managing shareholder liability if that's a concern. There are some miscellaneous tax changes affecting real estate, like the elimination of like-kind exchanges. There's going to be longer life for residential real estate. And there are some other sundry changes to the tax law. One of them is a favorite of mine, elimination of deduction for direct-to-consumer pharmaceutical advertising. So if anyone ever watches any U.S. TV stations, you'll see pharmaceutical advertising where they spend 60-second advertisement, of which 37 seconds is devoted to how wonderfully you're going to be able to play with your grandchildren after taking the drug. And the last 23 seconds are basically saying, but be careful of this, that, the other thing, and if you have a stroke, don't blame us, we're warning you, type wording. The elimination of deduction for this type of advertising might eliminate it effectively. And the other sundry changes is that there are going to be some additional retirement saving incentives to the middle class, which may not necessarily impact Canadians directly because we already have TFSAs, etc. Now, estate planning, there's been a lot mentioned about estate planning over time. I was practicing back in 1986 when President Reagan, with the assistance of the bipartisan Congress, reduced the top personal tax rate, federal personal tax rate, in the U.S. from 50% to 28% at the time. And one of the trade-offs was basically the elimination of tax shelters through mechanisms called passive activity loss rules, which basically killed the tax shelter business, notwithstanding whatever you might have read in the New York Times last week about Donald Trump's tax returns. Right now, Biden has not mentioned any reduction in the estate tax, but what has been mentioned is the repeal of the basis step-up at death. So when I was practicing in 1986, I had a very esteemed tax professor in the U.S. named Professor Sam Zeifmans, who told us now the only remaining tax shelter is death in the U.S. And the reason he morbidly suggested death is the only remaining tax shelter in the U.S. is because when someone dies, even if there's no estate tax due, the beneficiary of the estate, inherits the assets of the estate based on their value as of the date of death, or something called an alternative valuation date, which I won't refer to anymore, but based on their value on the date of death. So, for example, under current law, if somehow someone bought stock of Apple or Amazon for $50,000 15 years ago, and now it's worth $6 million, and the person passes away and you inherit the stock, you're inheriting the stock at a $6 million value, assuming that was the value on the date of death. And the only tax you would pay on a subsequent sale is on the difference between any appreciation that had occurred from the date of death till the date you sold it. It was quite a tax shelter. What Biden is suggesting is that under the same facts, instead of inheriting a $6 million basis in that Apple or Amazon stock, thereby getting rid of almost $6 million of gain that would be subject to tax, you will simply inherit the Apple or Amazon stock at the original cost to the person who passed away, which means you'd be inheriting it at a $50,000 basis, which means basically you'd be paying tax. The full value of the investment would not be escaping tax as it does under current law. Now, currently, I think the exclusion is probably closer to 11.6, even though I put down 11.8 because that's probably what it's going up to next year. But currently, the estate tax exclusion is 11.8 or so per person, or 20, which is 23.6 for two people, for a married couple in the U.S., which pushes it well over 30 million in Canadian dollars. So what this will do is it could have a very significant impact on the beneficiaries of the states where individuals bought things and held on to them forever. In fact, one of the greatest estate planning tools in the U.S. was telling people who owned highly appreciated assets not to sell them as they got older, just hold on to them and sell less appreciated stocks or other assets that they may own. So that is potentially a big one, even though no one has mentioned anything about reducing the estate tax exclusion, though we also know that the Democrats always put that on the table. So potential estate tax planning consideration, use of the Canadian corporation to hold U.S. investments. If you're a Canadian in the U.S. that holds such investments, aggressive gifting up to the current estate tax limitation. You can always gift away before you die. There's something called an intentionally defective grantor trust, which basically allows most trusts in the U.S., if you set up a trust, they're typically grantor trusts where all the income is taxed back to the grantor or the person who set up the trust, regardless how it's being distributed to beneficiaries. And if you set up an intentionally defective grantor trust, the income still gets taxed as such, but the way it's set up, the assets pass to the beneficiaries on the day it's set up, even though the income continues to be taxed to the grantor. There's the potential, of course, for something called Q-Dot trust to be set up for a non-U.S. citizen spouse to delay the taxation. And once again, there's the omnipresent option of renouncing U.S. citizenship. Now, believe it or not, the previous half hour was not brought to you by the committee to re-elect Donald Trump or anything like that. It is just a strict objective view of what Biden is proposing. But even if Biden proposes it, the legislative process in the U.S. is not as, shall we say, efficient as it is in Canada, particularly under a majority government. Simply because the president wants something to pass doesn't mean it's necessarily going to pass. Even members of the Senate and Congress of the same party might choose to differ from the president based on their local concerns. You'll find in the U.S. that senators and congressmen tend to be more answerable to their constituents than to the party leader, as the constituents have more of a say as to whether they become the nominee in a district or in a state than the party leader. So the way the legislative process works in the U.S. is that in order, let's say on November 3rd, Biden wins the election, which of course is not certain at all. And let's say the Democrats control both houses of Congress, which is possible, though unlikely. The legislation must be proposed in Congress at a committee level called the House Ways and Means Committee, and then brought to the floor of the House of Representatives, which is another word for Congress. If the legislation passes the House Ways and Means Committee and then goes to Congress and it's passed also, and there is a lot of back and forth at every level to get the legislation to pass. It then goes to the Senate Finance Committee, which is their equivalent of the House Ways and Means Committee, where if approved, it goes to the floor of the Senate for approval. Now, the Senate Finance Committee may want a completely different bill than the House Ways and Means Committee or Congress wants. And then once it gets to the Senate, it might get further adjusted. So if, but sometimes by some miracle, both houses pass legislation, chances are the legislation is going to be somewhat different between the two houses. So when both houses pass legislation and the legislation is different, a joint committee is formed that attempts to reconcile the differences between the House version and the Senate version, and then it's voted again by each member of by each House of Congress, and hopefully passes. If it passes, it goes to the president's desk, who may or may not sign the legislation, and Biden may or may not agree with the legislation, and there is a fair amount of horse trading that goes on at every level here. And also, for those of you who follow the news, that is how come the government runs out of money sometimes, because they just cannot get agreement at all of these different levels for funding sometimes. Now, to give you a frame of reference, after Donald Trump's election in 2016, the Republicans, it says Republications, it's Republicans, controlled all three branches of government. Donald Trump took office on January 20th, 2017. It took more than 11 months to pass the law that became the 2017 Tax Act. And the legislation was not even introduced till about a year after Election Day on November 2nd, 2017. So even though it was introduced, and even though there was Republican control of all three branches of, not all three branches of government, but at least Congress, both houses of Congress, and the presidency, it still took close to 2 months to pass the legislation, because there was a lot of trading back and forth. Marco Rubio, the senator from Florida, and Susan Collins, the senator from Maine, refused to sign on originally, and they only had a bare majority, so there had to be some concessions made. Now, Biden has an excellent chance of winning next month and delivering a Democratic majority in both houses of Congress. But even if that happens, it is unlikely that the legislation will be initiated immediately. Typically, as exciting as tax legislation is to people like me, it's not the most exciting thing for members of Congress to deal with. Certainly, the first order of business is going to be dealing with the COVID-19 crisis. But the COVID-19 crisis has left an enormous fiscal deficit. As well, Biden has promised student college loan forgiveness and other fiscal goodies, which means that they're going to be looking for new sources of funding once they get into office. The tax proposals, if you've listened to this presentation, you'll notice that the tax proposals are carefully crafted to impact the quote rich, which in the U.S. is defined as those making over $400,000 US a year, which I guess is more than double what you need to be rich in Canada. No member of Congress wants to die on the political hill defending a demographic perceived as rich by a large majority of the American public. So there's going to be enormous pressure on members of Congress to agree to this. Where you might see some pushback is in high-tax states like New York and California or New Jersey, based on the example I gave you a little bit earlier. people do not want to be paying, even if they're employed, do not want to be paying 59.5% tax on their marginal dollars of income, and these states are going to be afraid that there's going to be a complete demographic shift where people are going to be moving out of their states and moving into low-tax states if this legislation passes. And as Margaret Thatcher, the former Prime Minister of Great Britain, once suggested, taxing the rich is a great idea until all the rich leave. So the rich are usually pretty mobile and can go to different states to avoid at least high combined federal and state taxes. In a Democratic sweep, the individual and estate tax proposals have an excellent chance of passing, though. Corporate tax rate increases may get pushed back to a middle ground on a global competitiveness argument, whereby if you're talking about, as we said in the earlier example, about a 37% tax rate, there is a recognition that not only clients of Zeifmans, but major multinational corporations will undertake significant effort to attempt to move profits outside of the U.S. From the U.S., which could have the opposite effect, because also as you're moving profits, you might be moving high-skilled jobs out of the U.S., which are very desirable. Do you need to hire an engineer in California, or should you hire an engineer overseas in a low-tax jurisdiction, whether overseas is India or Ireland, whatever it might be, where you're going to pay lower tax for whatever the output of that individual is. So there's a concern that it might be bad for capital formation and therefore bad for employment if corporate tax rates go up. In fact, when President Obama was in office, he had proposed lowering the corporate tax rate from 34% to 25%. Biden is proposing 28%, which is even higher than what Obama had desired. The reason it never went down to 25% was because there was always at least one Republican House of Congress, and I guess they just couldn't bring themselves to agree with Obama on anything. So that never passed back then. Regardless of the outcome, there will be time to prepare. So I wouldn't panic even if you think Biden's a shoo-in to win, or even if on November 4th you wake up and Biden has won and they're Democratic houses, both houses of Congress are Democratic, even though with mail-in ballots it might be somewhat after November 4th. There will be time to prepare because in the example I gave you in 2017, legislation was not even backdated until November 2nd. There was still a solid 10 months after Trump took office had you had a crystal ball to rearrange your affairs. Here we have a pretty clear indication of where the direction Biden wants to head to with tax legislation should he win. And the other thing I would note that typically Canadian governments tend to follow best practices of the U.S. government, much as Trudeau ran on Obama's theme of taxing the rich. At one point, the U.S. got rid of, proposed a 50% disallowance for meals and entertainment expenses, which is now 0% in the U.S. Shortly thereafter, Canada proposed the same thing. So it would not be surprising to see a Canadian company embrace some of these ideas, like enlarging CPP to higher rates, etc. So that's something we have to be cautious of, especially with the significant deficit that's being run up these days in Canada. So having said all that, that was a bit quicker than I had anticipated, a few minutes quicker. The floor is open for questions. Okay, so someone has asked, bottom line, for a Canadian citizen who is a U.S. resident, better not to seek U.S. citizenship. Well, if you're a U.S. resident, the person who asked that question, if you're a U.S. resident, you're going to be subject to these rules for the period of time you're a U.S. resident and for the period of time that you're holding a green card, if that's the case. Once you move back to Canada, if you choose to move back to Canada, you will no longer be subject to these rules. I mean, if you have a green card, you might have to give up your green card. But yes, if you're considering U.S. citizenship and Biden wins the election and you're concerned about the impact of these potential rules on being a U.S. citizen, becoming a U.S. citizen, yes, I guess it's a subjective decision, but you have to give pause. But there are benefits to U.S. citizenship also, particularly for people who don't like cold winters, etc. There are subjective reasons people want to hold on to Canadian citizenship. Another question, do you feel that Biden's policies might lead to increased expatriation to Canada for both CFCs and high net worth individuals versus moving internally in the U.S.? Well, it's very interesting. It was widely publicized that in the hour after the debates on, I think it was Tuesday night, Google had an upsurge in searches for moving to Canada, particularly from people in Massachusetts, Ohio, and Pennsylvania. So I think it's possible. I have dealt with one client who was moving from Washington State to BC because they didn't like what was going on in the U.S. But no, I don't necessarily think there'll be an uptick. First of all, if you're a U.S. citizen, it doesn't relieve you of a lot of the responsibilities of U.S. filings if you move to Canada. As well, if you're looking to avoid tax, I'm not sure Canada is the #1 destination in the world to avoid high taxes. I could think of a lot of other destinations to avoid high taxes. Are there any other questions? Okay. Somebody has asked the question, would you see any changes in how the USA deals with TFSAs, tax-free savings accounts? Now, in the last year or so, the IRS has issued a pronouncement which basically said that in the past, you've had to file certain additional forms, trust forms, or we believe you've had to file those trust forms for investments in RESPs and TFSAs. The IRS pronouncement basically has said that for items such as an RESP, which is for educational purposes, you will not have to file those forms anymore. For TFSAs, it did not fit the criteria, although one might argue, as we are looking at right now, whether TFSAs are in fact trusts or they're just simply a bank account. Trust in the traditional U.S. definition of what a trust is, or a bank account. Nonetheless, any income inside TFSAs and RESPs, it's irrefutable that that has to be included on the U.S. return, in the U.S. income of a U.S. citizen who's resident in Canada, regardless of the fact that it might be excluded for Canadian purposes. Another person has asked, does large U.S. capital gain step-up value change affect Canadians? It might affect Canadians. Where I see it affecting Canadians, I'm not sure if the question is relating to the 39.6% tax or the step-up, so I'm going to address the step-up on death. It only affects Canadians were inheriting, I believe they were inheriting, I'm not a Canadian tax expert, but you inherit the assets of a decedent at the fair market value regardless. This would only affect Canadians to the extent that those Canadians who are beneficiaries are U.S. citizens, because they would have to assume the U.S. Cost basis, not the fair market value. Although I can't answer the Canadian side of that question with any level of assurance. Okay. I don't see any other questions, so I guess we'll wrap up. I want to thank everyone for taking the time to participate in this webinar. It's been my pleasure to give it. If anyone would like to reach out to me outside the webinar, feel free to. You know where to reach me, or go through Zeifmans' website to try to reach me. In any event, once again, thank you very much for your time, and I look forward to hearing from you. Thanks.